go ahead and get started. I'm going to run through some introductory stuff here first, and maybe some people will trickle in while I'm doing that. So first off, my name is Chris Bullock. I am a loan officer with Cross Country Mortgage, your in-house lender here at KW Living. So just wanted to kind of run through, first off, where the market is right now. This is a website called Mortgage News Daily. Myself, as well as many other loan officers, like to reference this website to see what the kind of national average interest rate is. Reason being, this site does a survey, a daily survey of many lenders all across the country, and they kind of give a median of what all of these lenders are offering at that time. Usually comes out first thing in the morning. So as you can see today, the average interest rate on a 30-year fixed loan is about 7.2%. Most lenders, when they're quoting this, they're quoting 20 to 25% down on a conventional loan. You can see FHA on here. Sometimes they're including a little bit of points in there, although that doesn't show up on here. So, I'd say it's a good average. It's a good number to kind of say, okay, this is about where rates are. Really, that number can fluctuate a bit depending on qualifications. So I would never say, hey, you're absolutely 100% going to get a 7.2. We'd need to pull a credit report and look at your qualifications and everything to be sure about exactly what rate you would be getting. But this at least gives us an idea of where the market is at the moment. You can see, I like this chart, kind of shows you the last several years here, where rates have gone. They chopped up and down through, 2014, 15, 16, 18, 17, 18, 19. And then you can see, obviously, what happened after COVID. And then we have been on this kind of rise and chopping up and down here at the top for the last several months, couple of years even. So I'm going to get into today some things that might be able to help you navigate these interest rates, navigate the market, and discuss a little bit more about who's in this market. Let me share my screen here. All right, perfect. So let's see. There we go. So a big thing about the current market we're in is a lot of your normal move-up buyers are in what's called a locked-in effect, meaning they refinanced or purchased with a super low interest rate sometime in 2021 or the beginning of 22. And now, even if they have motivation to move, they're certainly going to see an increase in their payment. Some people that, maybe they're getting older, they would otherwise downsize. Just downsizing might mean a larger payment because of where rates are. We have to kind of figure out how to navigate that and how to come up with answers to objections. So I start off here with naming a few objections. I wanted to discuss too a little bit about the dynamics of who's purchasing a home right now. First-time home buyers make up almost half of the purchases in 2023, which is much higher than it was in 2021 or 22. So I have like a whole class about first-time homebuyers and grants and things like that. So I won't get into all the details on that. I think we have a recording of it because I just did it last month. But cash and first-time homebuyers taking advantage of the benefits of being a first-time homebuyer. Those are kind of the people that are making up the majority of the market. Everybody else are people that are moving because they need to. Baby on the way, new job, relocation, moving back home. Everyone I talk to, if they're getting out of a lower interest rate on their primary and they're taking a new one, it's because the life is moving them. They're not necessarily just saying, hey, I'm tired of this house, let's move on to something else. So some common objections that we run into, you can see right at the top there. It's too expensive. The interest rates are too high, and the funds to close. I just don't have the funds to close. So just to kind of answer a few of these. There's no way I can afford a home with how much housing prices have gone up. Uh, that may be true, but incomes have gone up pretty consistently for the last several years as well. A lot of people think that they are going to be qualifying, especially people that are first-time home buyers, feel that they're going to be qualifying off of their take-home pay. That's not necessarily true. People are qualifying off of the gross income. So before taxes are taken out, before they pay for their health insurance or contribute to a 401k or retirement account, that's the number we're going off of. If they have any kind of child support or something that's collected out of their pay, we do need to factor that in. But for anyone that doesn't have that, we use the top number. So your salary is what carries the qualification, not your take home. Just graduated a couple years ago and I probably can't afford it. That's not necessarily true. A lot of people are very startled by student loans. Luckily, with some changes that happened over the last, I believe it's been about a year now, income-driven repayment plans for student loans are way more forgiving or friendly on the monthly payment than they were before these changes were made. So your payment is tied to how much you make, and they look at your W-2 income to come up with that. Before, I can't remember what the exact calculation was, but before it was about twice as much as your payment would be now if you sign up for that income-driven repayment plan. So for everybody out there that has their student loans currently in deferment, not a whole lot of people do, because if you remember back in October, those started back up. I've been telling them, hey, it might be worth it to go apply for an income-driven repayment plan because your payments might be a lot lower than you expect. The other good news is if you show a $0 payment on your income-driven repayment plan, meaning your income is too low to even need to pay on those loans currently, we can just mark those as a $0 payment, and we can more or less ignore those student loans. Has to be cheaper to rent than buy, right? Not necessarily, no. And we have the tools to help you with that. And I get into that a little bit more with a rent calculator. We'll touch on that later in the presentation here. Now to jump over to column 2, interest rates. My cousin said it's a bad time to buy because interest rates are high. Everybody's got a relative that's been watching too much news. And the headlines, they tend to, draw eyeballs, not necessarily, playing the truth. I saw a headline the other day, rates hit 8.5%. That's not true at all. I mean, maybe if you're doing a really weird niche program, you got bad credit, but most people, as I showed you a few minutes ago, are in the low sevens. So historically, we're on about average. In modern history here, the average interest rate is around 7.5%. So, I know it's hard to stomach given where rates were in 2021 and 22. Obviously, home prices are up, so people are feeling that heat as well. But the interest rates themselves aren't necessarily all that high, compared to where they would normally be. I think if you jump back to even 2018, interest rates are around 5%. So, I'm thinking over the next few years, couple of years, hopefully, we can get back down to around 5%. But for now, interest rates aren't that crazy high. If you're also looking for some good news, rates have gotten relatively high compared to the modern averages. I want to say October of last year, it hit like 8.5%. So certainly that was high compared to where we are today. I saw on the news that rates have doubled. Didn't I just wait to buy? If you talk to someone in 22 that said that to you, and they waited, they missed out on a ton of equity by sitting on the sidelines, just a ton. I mean, that person would have been better off to take a 7% interest rate and purchase a home in 22 rather than wait till 24 or 25 with the hopes of maybe getting a 6.5 or a 6% interest rate, because they missed out on so much equity. And you can see that in the rent versus buy calculator, which we'll get into here in just a minute. I would love to buy now, but my budget has gone way down because of the recent rate increases. Maybe, but we might be able to navigate that. And I'll get into that a little more. Seller credits can be used to buy interest rates down. There are buy down programs where you can have a lower interest rate for the first couple of years. I'll get into those details, but it's an easy answer to try and get someone off the fence. All right, funds to close. I have good income, but I don't think I have enough saved up. That is something I run into a ton. Being that half of the market these days is first-time home buyers, many of them have saved up just enough to cover, a down payment or a relatively small down payment, but we don't know where closing costs are going to come from. Or maybe in some cases they've got some money in retirement, but they don't have a whole lot of cash. We have ways around that. I mean, obviously you can pull from your savings account, but you can also borrow against your 401k. You can get a loan against any life insurance policies you have if they have cash value. Down payment assistance programs. I mean, there's tons of them now. Cross country, we have a $6,500 grant program and then a 2% grant program. I've got, not kidding at all, probably 30 or 40 pre-approved buyers who are actively shopping who are going to get grant money. It's usually tied to, one, the fact that you're a first-time home buyer, and two, well, depending on the program, there's income limits on one, and then there's the other is based off of where you currently live. Doesn't matter where you're purchasing, but if you live in a census tract area that is deemed qualifying for this program, there you go. If you're curious on what those areas are, let me know. I can kind of give you a better breakdown, but generally it's low to moderate income areas that are going to qualify for those programs. So I want to buy, but all my money is tied up in other investments. I hear that one a lot too. A lot of people with the way that let's say you bought a CD or something, you're getting a nice high interest rate on that. Maybe you don't want to sell it. We have some options. There's, bridge loans. You could get a home equity line of credit against an existing property. There are assets out there that are accessible, I mean, really a HELOC and a bridge loan are pretty much the same, except one is truly just a line of credit based off of the equity. The other is accessing the equity in a short term, just so you can put a down payment on something else. You'll need to sell it and then pay that bridge loan off fairly quickly because it balloons in, I believe, about 4 months. I have 3.5% down payment, but can't produce funds for closing costs. Talked about that a minute ago. We can get a credit put together from the seller in some cases. I mean, the solution I usually throw out there, obviously, it all depends on what the property appraises for. But let's say you're buying a house for $150 and the closing costs are going to be about $5,000. The seller doesn't want to go below $150 on their net. Understood. We don't have cash to pay those $5,000 closing costs. Okay, well, what if we bump the price up to $155 and ask the seller to give us $5,000 back? As long as it appraises at $155 and our buyers qualify for a $155 purchase price, we're good to go. The seller nets out the same. We get the closing costs covered, and honestly, in most cases, $5,000 in a higher loan over 30 years is really not that big of a jump on the payment, and most buyers are more than happy to go for it if it works. So, any questions on any of that? All right, cool. So we'll get into a little more detail on some of these items. First thing, seller credits. 2 years ago, they were few and far between. And that's being nice about it. I mean, most sellers had so many offers coming in, they wouldn't even consider an FHA. They wouldn't consider any seller credits. I mean, heck, most people were covering tens of thousands of dollars in appraisal gaps and, paying over asking. But these days, I'm finding way more seller credits. I'm also noticing that sellers, or rather buyers, are getting more negotiations done after the contract is accepted and once you go into the ROC negotiations. I'm seeing a lot of credits come back from that. And I think the reason is sellers don't want to have to relist the property and risk, getting stuck in that looking stale, quote unquote, on the market. So they're willing to give up a few $1,000s just to make sure the deal goes through. Whereas up front, maybe they weren't so, on board for something like that. So, I mean, I had one the other day. It's in Columbus, so a bit different market, but still here in Ohio. Went to multiples. My buyers won it. Went to the inspection. There were some items that they wanted to address. Sellers didn't want to mess with it. They just were like, heck, let's just go with a $7,500 credit. And it got accepted. I couldn't believe it. But the sellers, they wanted to move, and they were willing to kind of walk back any line in the sand they had on seller credits, and it paid for all our closing costs and bought the rate down a little bit. So what can we use those credits for? Temporary buy down, I'll get into that in the slides coming up. Paying points. So you might hear a lot of lenders quote things like points, origination fees. Really what it is you can get pretty much any interest rate you'd like. However, there's a cost to it. So if someone says, I don't care how much it costs, I want a 6.5% interest rate, you can do that. It's just going to come in the form of points that are going to be listed in their closing costs. Seller paid PMI, so the seller can fund paying off all of the PMI for a buyer. The costs on that are going to depend on many different factors that end up generating the mortgage insurance rate, but you can pay one time to have that paid off. And then the breakdown on closing costs, 6% for FHA, 3 to 9% for conventional, depending on how much they're putting down, 2% for investment properties, and 4% for VA, and that goes beyond even just the normal closing cost. So, all right, we'll keep it going. Temporary buy-down programs. So these have become popular over the last few years. I mean, a lot of lenders, they're pretty much just quoting these in everything they do. There's a catch. These cannot be funded by the buyer. They have to be funded by an interested third party. We don't really do them unless we can kind of negotiate to make it work for the buyer, given a competitive situation. I always throw it out there that it's an option, but it'll really depend on the structure of the deal when it comes to the lender. You as a third-party agent, you could fund one, but I've never seen that before. More often than not, what happens is the seller. Those seller credits that I was talking about a minute ago, those can get used to fund one of these buy-downs. So what is a buy-down? Well, a buy-down is basically taking an interested third party's money and prepaying the interest over a set number of years. So each scenario it's the term for what type of buy down it is. A 1-0 buy down, that means there's a 1% lower interest rate in the first year only. 1-1 is 1% buy down for the 1% lower interest rate in years 1 and 2. 2-1 is 2% in the first year, 1% in the second year. And in 3-2-1 is, as you can see, 3 in the first year, 2 in the second year, 1 in the third year. And then after all of these buy down periods are over, it goes back to the interest rate that was locked and closed on at closing. And it's like that through the remainder of the loan term. So in most cases, 30 years. The nice thing about this program is these funds are taken at closing, they're put into an escrow account. So if someone does a 2-1 buy down, let's say it's about 2% to fund that. Let's say 2% of the purchase price goes into this escrow account. In the first year, they have a 2% lower interest rate. So instead of 7%, they say have 5%. At the end of that year, it's going to jump up to 6%, but maybe interest rates themselves have already gotten down to, let's say 6%. And they want to lock that interest rate in for the rest of their term. They want to refinance the loan at a 6% interest rate for 30 years. That money that's in escrow can be used to fund that refinance. It's their money. It's just sitting in an escrow account. So the really nice thing is you can use it to help pay for a refinance and lock in a lower interest rate. This is a great problem solver in the short term. If buyers are just looking for the lowest possible interest rate for the next year or two, they feel that the market's going to, come down, that interest rates are going to come down accordingly. Maybe, the hot market's going to slow down a little bit. They can do this in the short term so that they can just have that lower interest rate and then lock something in long term with a refinance. Any questions there? All right. Here's some math on this. I won't stay on this too long, but basically just breaks down how we come up with calculating a payment, or I'm sorry, the funds needed to fund one of these buy downs. What are points? I talked about that a little bit a minute ago. Your buyers basically are paying it to get a lower interest rate. You can see a little breakdown there, reducing rate by as much as 0.5% using only 1% of the loan amount. So it really depends how much points cost, how effective the points are. So how much lower you get in rate given your, let's say 1% in points. Really depends on it's tied to the news, the stock market, the bond market. So it moves right alongside interest rates every day, sometimes multiple times a day. So it's really hard to estimate exactly what your points would be able to get you. That being said, we can kind of get an idea of how effective those are. And what I end up doing is I just wind up pulling my price book up and quoting a number. So if you have someone that's curious, I can quote that for them. Seller paid at PMI, talked about that a little bit already. The PMI does not always have to be added into the buyer's monthly payment. That's a big thing that people don't always know. They think that PMI is, and this is on conventional loans, FHA is a little bit different, but for conventional loans, you don't necessarily have to do monthly MI. The buyers themselves, if they wanted to, could pay to have the PMI, closed out at closing. Depends on their qualifications and how much that's going to cost, but every now and again we see it. And then CCM introduced a program just in this past fall. We do 15% down, no PMI. So if someone wants to do 15 down, no MI, we can do it. What it is there's PMI on there, or rather there's PMI in the transaction, but we pay for it when they're putting 15% down. So cross country is just paying off their PMI, and then they effectively never have it, ever. One thing about it is there are some stipulations. They can't go all the way to the max of their budget. The debt to income ratio has to be under 43%. They have to have over 740 credit. And that the reason is someone with under 43 debt to income and over 740 credit, they get a much better insurance premium than someone that's outside of those. The costs just get too expensive for us to take it on whenever they're not meeting all those qualifications. So I've done 2 of them in the last 6 months. When people hear about them, they love them. So something to sell. Seller concessions, we talked about that a little bit already. I kind of got ahead of myself on explaining some of the stuff in earlier slides, but more math there at the bottom. Rent versus buy. So there's a really good calculator link here. If you go to my webpage, ccmbullock.com, so that's CCMB as in boy, ULLOCK.com. There's a little resources tab. You can go to calculators, and there's everything you can think from amortization schedules. Hey, what if I make an extra payment every month? How quickly am I going to pay off my mortgage? One of them is this rent versus buy calculator, where someone can plug in how much they're paying in rent now and how much their mortgage payment would be, or I think you plug in the loan amount, taxes, insurance, things like that, and then it kind of generates how much you're missing out on. And there's certainly a break-even point where what I usually tell people is, if you're only going to live in Cleveland for the next year, I probably wouldn't necessarily buy a house. I don't know if you'll break even on your investment in 1 year, given the closing costs and everything. But if you're going to live somewhere for 3, 4, 5 years, it makes all the sense in the world to purchase versus buy, or I'm sorry, purchase versus rent, given this rental calculator kind of showing you how much you're going to be missing out on equity, and how much you're more or less just building your landlord's equity. Here's a little breakdown of what that calculator looks like. $250,000 home, 5% down, taxes of $5,000 per year, and insurance at $1,200 per year at a 7% interest rate. So, all of that sounds like a 250 house in University Heights, for example. That's where I live. Compared to $1,600 per month in rent with $200 per year in renter's insurance. So you can kind of see the analysis on that. Over 30 years, buying costs you $481, renting costs you $800. And a big thing for me is, getting that process started now versus waiting. Because I think a lot of people are just afraid to take the leap. But if you can show somebody that they're missing out on, or they're overspending over $300,000 over the next 3 years or 30 years, hopefully that kind of rattles the numbers into their head. Big thing is finding your niche in this market as well. Some specialty products we have, renovation. So if someone wants to do a purchase with renovating, it's as extensive as you want it to be. We do 203K, which is FHA's version of it. We also do conventional renovation. We do a full construction program. So if someone wants to purchase land, or they maybe own land already and they want to construct a home on it, we're not seeing a ton of that these days, honestly, just because the builders market tends to be more the builders own the home until they finish it up and then they sell the finished product. We do loans on those all day, but they're just more like a regular, purchase loan versus the full construction. This would be us funding the construction through the whole process using a builder that's more like a general contractor. Investment, Journey Tool is a great person to talk to. The Magnos, great people to talk to about investments. They have built their whole business around just servicing and working with investors. So that is a market that, no matter what's going on with interest rates, they're not necessarily going to stop purchasing. I had a huge portfolio of investors in 21 and 22, doing multiple loans for multiple investors. Unfortunately, interest rates got high. The investors that had the means to go with a cash or a hard money option were going to go, a lot of them were going that direction, with the thought of, hey, when the interest rates get a little more favorable, we'll come back and we'll do a refinance to pull the equity out and do some more purchases. But that market just hasn't slowed down. They've changed the way they're approaching purchasing. They haven't necessarily stopped purchasing. So great market. And then relocation. I know a lot of people that just work the relo market. There's always people coming and going. You get a lot of referrals, where someone's moving to another location and you get to refer that out to another KW agent in another area. So great thing to get into. And then I wanted to talk a little bit about alternative options here. Obviously, we talked about first-time home buyers, down payment assistance, grants, all of that. But there's two other things I wanted to talk about. One is delayed financing. A lot of people don't realize that there's a difference between, purchasing a home with financing or purchasing a home with cash. You can kind of purchase with cash and then immediately get a loan with favorable terms. It's called delayed financing, and there are some stipulations to it, few things you need to document. But if you're truly just using cash and you're not getting a mortgage on the property, you can do one of these delayed financing loans within 6 months of closing. In some cases, the tricky part is some people like to, let's say, get a gift from a parent. Let's say mom and dad give them $300,000 cash to purchase the property. They purchase the property and then want to do this, refinance, cash out refinance to try and pay mom and dad back. The catch with that is gifts, and this is on conventional and FHA guidelines, gifts cannot be repaid. A gift is meant to be a gift, and that's it. That being said, we have found a way to work around it. If you can get a temporary loan from a relative and document it, we have been able to show that that loan is being paid off with the cash out refinance. And then, it doesn't technically count as like a mortgage. You can always borrow against retirement savings, 401k, things like that, or bridge loans. Talked a little bit about those earlier, but temporary balloon loan just to kind of get you from one property to the next. And then the other thing I wanted to talk about, portfolio loans, also referred to as non-QM loans. Think of these as loans that don't fall into conventional or government loans. So these are, let's say 96%, 97% probably of purchases are with FHA, VA, conventional, and maybe some of those are USDA. The others are going to fall into these programs. And what they are is DSCR, which is basically an investor cash flow loan, meaning the property is going to be an investment property. The intention is for the buyers to never be moving in. That's an important factor. If the property's anticipated rental income offsets the mortgage, taxes, and insurance, it qualifies. So it's a very simple program. 1099, that's for people that, realtors, good example here. If you get a 1099 and then you file taxes and you take all of your expenses out and everything, and you're showing maybe very little income or even a loss, and most lenders would say with conventional, hey, we need 2 years of taxes, and whatever the bottom line number is, that's what we can use. Well, the 1099 program doesn't even look at your taxes, just looks at two 1099s you have, and then we do a 10% allocation for expenses. So basically, whatever your 1099 shows, 90% of that can be used to qualify you. I did one for an agent in this office, slam dunk deal. It's nice and easy. Bank statement loans, that's for people that are self-employed that have a lot of income coming in. They're having a similar, issue with the tax returns as someone that's doing a 1099 loan. With the bank statement loan, though, we're looking at average deposits over like a 24-month period. So if someone has a lot of money coming in and then they have money going out too for expenses, we can do an average of the deposits. You have to set aside a bit for expenses as well, but it's a great program. And then asset qualifier, that's more for individuals that don't have income on paper, but they have a lot of money. If you have a lot of money, someone's going to give you a loan, right? So what we can do is we have a calculator that we plug in. Let's say somebody's got a few $1 million worth of assets, investments or something of that sort, and we can, kind of show that. We can qualify them based off of the assets that they have. One important thing to note is with these loans, because they're non-traditional, they are, in the eyes of an underwriter, a bit riskier. The interest rates tend to be a bit higher, costs are a little bit higher. The nice thing is they solve problems. So if someone can't get a regular conventional loan or even an FHA loan, these can jump in and kind of save the day. Any questions there? All right. Well, I appreciate you stopping by. Like I said, my name's Chris Bullock. I'm with Cross Country Mortgage. I'm the in-house lender here. So if you're in the office, stop by. I have the first office just to the right of Brian's desk up front. Knock on my door, say hello. I'm here 4 days a week. So
Thank you.
absolutely. Thank you.